as a trader for Citigroup. He was profitable every year, and his trading line and responsibilities steadily increased. By the time O'Shea left Citigroup in 2003 to become a portfolio manager for Soros Quantum Fund, he was trading an exposure level equivalent to a multi-billion-dollar hedge fund. After 2 successful years at Soros, O'Shea left to become a global macro strategy manager for the multi-manager fund at Belisny, a portfolio that was to be the precursor for his own hedge fund, Comac, formed 2 years later. O'Shea has never had a losing year. The majority of his track record, spanning his years at Citigroup and Soros, is not available for public disclosure, so no precise statements about performance can be made. The only portion of this track record that is available for the period at Belisny, which began in December 2004, and his current hedge fund portfolio, which launched in June 2006. For the combined period, as of end of 2011, the average annual compounded net return was 11.3%, with an annualized volatility of 8.1% and a worst monthly loss of 3.7%. If your first thought as you read this is only 11.3%, a digression into performance evaluation is necessary. Return is a function of both skill in selecting, implementing, and liquidating trades, and the degree of risk taken. Doubling the risk will double the return. In this light, the true measure of performance is return/risk, not return. This performance evaluation perspective is especially true for global macro, a strategy in which only a fraction of assets under management are typically required to establish and maintain portfolio positions. Thus, if desired, a global macro manager could increase exposure by many multiples with existing assets under management, i.e., without any borrowing. The choice of exposure will drive the level of both returns and risk. O'Shea has chosen to run his fund at a relatively low risk level. Whether measured by volatility, 8.2%, worst monthly loss, 3.7%, or maximum drawdown, 10.2%, his risk metrics are about half that of the average for global macro managers. If run at an exposure level more in line with the majority of global macro managers, or equivalently at a volatility level equal to the S&P 500, the average annual compounded net return on O'Shea's fund would have been about 23%. Alternatively, if O'Shea had still been managing the portfolio as a proprietary account, an account type in which exposure is run at a much higher level relative to assets, the returns would have been many times higher for the exact same trading results. These discrepancies disappear if performance is measured in return/risk terms, which is invariant to the exposure level. O'Shea's gain-to-pain ratio, a return/risk measure detailed in Appendix A, is a strong 1.76. I interviewed O'Shea in London on the day of the royal wedding. Because of related street closures, we met at a club at which O'Shea was a member instead of at his office. O'Shea explained that he had chosen to join this particular club because they had an informal dress code. We conducted the interview in the club's drawing room, a pleasant space, which fortunately was sparsely populated, presumably because most people were watching the wedding. O'Shea spoke enthusiastically as he expressed his views on economics, markets, and trading. At one point in our conversation, a man came over and asked O'Shea if he could speak more quietly, as his voice was disrupting the tranquility of the room. O'Shea apologized and subsequently dropped his voice level to library standards. Since I was recording the conversation, as I do for all interviews, I am such a poor note-taker that I don't even make the attempt. I became paranoid that the recorder might not clearly pick up to the now softly speaking O'Shea. My concerns were heightened any time there was an increase in background noise, which included other conversations, piped-in music, and the occasional disruptive barking of some dogs one of the members had brought with him. I finally asked O'Shea to raise his voice to some compromise level between his natural speech and the subdued tone he had assumed. The member with the barking dogs finally left, and as he passed us, I was surprised to see, although I really shouldn't have been, that it was the same man who had complained to O'Shea that he was speaking too loudly. When did you first become interested in markets? It was one of those incredible chance occurrences. When I was 17, I was backpacking across Europe.